Welcome to This Explainer. Today, we're diving straight into the math and mechanics of the U.S. tax system to bust what is, frankly, one of the most widespread and costly financial myths out there. We're going to break down exactly how your paycheck is taxed layer by layer so you can make confident, informed decisions about your career. So if you've ever looked at tax brackets and felt completely confused, well, you are definitely in the right place.
Picture this. Your boss calls you into their office, praises your hard work, and offers you a big promotion along with a $5,000 raise. Would you ever say no to that? I mean, it seems like a total no-brainer, right? But surprisingly, a lot of people actually do decline raises or they refuse to take on overtime shifts. And why? Because they're genuinely afraid that earning more money will bump them into a new tax bracket and ultimately leave them with less money in their pocket.
And that fear right there brings us to the core of what we're tackling today, the raised myth. It's this incredibly common, yet entirely, totally incorrect belief that moving into a higher tax bracket means your entire paycheck suddenly gets slapped with a massive tax rate. People literally think, oh man, if I earn just $1 more and cross that line, the government is going to take a huge chunk out of everything. It's a completely understandable fear, but as we'll see in just a minute, the math just doesn't work that way.
Okay, so to bust this myth wide open, we first need to define a really critical term, the marginal tax bracket. This is simply the specific tax rate applied only to the next dollar you earn, not your total income, just the next dollar. See, the United States uses a progressive tax system. That means your income isn't just treated as one giant pile that gets hit with a single percentage. Instead, it's actually divided into different layers.
Honestly, the easiest way to think about this is like a staircase. Each step represents a different tax bracket, and each step has its own specific rate. As you earn money throughout the year, you start filling up that bottom step first. Once that step is completely full, any extra money just spills over onto the next step up. And here's the magic part of the whole system. Only the spillover money sitting on that higher step gets taxed at the higher percentage. All your money on the lower step, that stays perfectly protected at its original lower rate. Let's invent a really simple, fictional tax system just to keep the math super clean. Imagine a three-step staircase. Step 1 is for income from $0 to $10,000, and that's taxed at 10%. Step 2 is for income from $10,001 up to $20,000, taxed at 20%. And finally, Step 3 is for any income over $20,000, taxed at 30%. You can clearly see how the income is chunked into these distinct ranges.
All right, let's bring in a hypothetical worker to see how this works in practice. We'll call her Sarah. First, imagine Sarah earns $8,000 for the year. Since $8,000 is less than $10,000, all of her money stays comfortably right there on the very first step of our staircase. It's a super simple calculation. 10% of $8,000 is $800. So Sarah pays $800 in taxes and she takes home $7,200. Easy enough, right?
Now here comes the promotion. What happens when Sarah gets a raise and her income jumps to $15,000? Well, under the raise myth, someone might panic and say, oh no, $15,000 pushes Sarah into the 20% bracket. She's going to owe 20% on the whole thing. But actually, scratch that, it is entirely wrong. Let's run the actual math using our staircase. Her first $10,000 fills up the first step at 10%, giving us $1,000 in tax. Only the remaining $5,000 spills over onto the second step at 20%, which is another $1,000. Add those together, her total tax is $2,000, meaning Sarah still takes home $13,000.
Okay, let's push this even further. Sarah is absolutely crushing it and now earns $25,000, officially hitting that top 30% bracket. Let's break it down one last time. The first $10,000 at 10% is $1,000. The next $10,000 fills the second step at 20%, which is $2,000. And finally, that remaining $5,000 spills onto the third step at 30%, which equals $1,500. Add it all up, and her total tax bill is $4,500. This proves perfectly that even though Sarah technically reached the 30% bracket, the vast majority of her money was taxed at the much lower rates of 10% and 20%.
Now, if the whole staircase idea is still a bit fuzzy, let's talk about pizza. Think about a pizza shop running a very strange and honestly terrible progressive promotion. The first slice you buy costs $1, the second slice costs $2, and the third costs $3. If you step up to the counter and order 3 slices, the cashier doesn't look at you and say, well, since you bought 3 slices, every single slice now costs $3. That would be absurd. You literally walk out of the pizzeria. You pay $1 for the first, $2 for the second, and $3 for the third. Tax brackets work the exact same way.
All right, let's put this myth to the ultimate head-to-head test. Imagine a system where income up to $50,000 is taxed at 10%, and anything above that is taxed at 20%. Person A earns exactly $50,000. Person B decides to work some overtime and earns $51,000, crossing into that new 20% bracket. Now, according to the myth, Person B just made a massive mistake.
But here is the mathematical reality of the situation. Both Person A and Person B pay the exact same 10% tax on their first $50,000. Their paychecks are identical up to that exact point. It is only that extra $1,000 Person B earned that gets hit with the 20% rate. So, Person B pays $200 on that final $1,000, leaving them with $800 extra in their pocket. Person B takes home more money than Person A every single time. The bottom line, earning more money always leaves you with more money.
Okay, so with the myth officially busted, let's establish some concrete vocabulary so you can actually read and understand your next paycheck. You are going to hear two terms thrown around a lot: marginal tax rate and effective tax rate, and they are very, very different. The marginal tax rate is the tax applied to your highest step, basically the tax on your next dollar earned. But the effective tax rate, that is the real-world percentage of your total income that actually goes to taxes.
Your effective tax rate? That's your ultimate truth teller. It's the number that matters because it averages out all those different rates you paid across all the various steps. And the formula is wonderfully simple. You just take your total tax paid and divide it by your total income. That's it. That one single calculation gives you the absolute truest picture of your actual tax burden.
Let's actually plug Sarah's numbers into this and see what happens. Remember her final scenario? Sarah earned $25,000, which pushed her top dollars into that sort of intimidating 30% marginal bracket. We did the math layer by layer and found her total tax bill came out to $4,500. So to find her effective rate, we just take her total tax of $4,500 and divide it by her total income of $25,000. And boom, 18%. Just let that sink in for a second. Sarah's marginal bracket, the absolute highest rate she touched, was 30%. If someone asked her at a party, she might groan and say, I'm in the 30% tax bracket. But her effective tax rate, the actual slice of her income she sent to the government, was only 18%. It's a huge difference. Your effective rate will almost always be significantly lower than your marginal rate. Now you might be thinking, why do governments even use this progressive, layered system in the first place? Well, generally speaking, supporters argue it's a matter of fairness, that people with a greater ability to pay end up contributing a larger share to help fund public services. On the flip side, critics argue that penalizing higher earnings with higher rates actually discourages productivity, business growth, and overall investment. Financial literacy isn't about taking a political side here. It's simply about understanding exactly how the math functions so you can best navigate the system for yourself. So let's just lock in what we've learned today. Number 1, your income is taxed in layers, never as one giant lump sum. Number 2, higher tax brackets only ever touch your new or spillover money. Number 3, a raise is absolutely always a good thing, because earning more mathematically guarantees you keep more. And finally, your marginal rate is just your top step, while your effective rate is the true real-world average you actually paid. I've actually got a quick challenge for you. The next time you get a pay stub or you sit down to file your taxes, don't just glance at the final number and file it away. Take a moment to find your marginal bracket on the federal tax tables. Then, use our simple division formula to calculate your own effective tax rate. Seriously, comparing those two numbers will completely change how you view your paycheck from now on.
I want to leave you with a quote that perfectly summarizes everything we've uncovered today. The tax bracket you reach does not determine how all your income is taxed. It only determines how your next dollar is taxed. Keep that truth in mind, and please never be afraid to go after that promotion. But it really begs the question. If a myth this incredibly common has been keeping people from making more money, what other financial myths are currently draining your wallet without you even realizing it? Thanks for joining me for this explainer, and we will see you next time.